So in this chapter, basically we're learning about the bookkeeping process, the transaction analysis, and essentially we're learning how to actually keep the ledger of the book that you're working with. And keep in mind that now that you know the final product, financial statements, the final application, financial analysis, reporting, now we're talking about actually how do you book that one transaction. And to give you an example, yeah, it's getting into this equation: assets equals liabilities plus stockholders' equity, which basically goes a little bit more complex into what adding income and equity and things like that. But to back it up in a second, whatever goes into the business, the way accounting tracks it, it kind of becomes like a closed system. I would think of it more kind of like, I guess I'm not so much of a chemist, but I'm thinking like, say, imagine you had water that you're boiling turns into steam, and say it's all in a closed system. So whatever it is water or steam or ice, is going to remain in that room, for example. That's how asset liabilities and stockholders' equity work. You have to think about it as like whatever comes in and out of the system is still going to be one of those three. It's still going to touch one of those three, and it's going to bounce. And it's going to bounce. So there's no such thing of it's leaving completely. And that's why this equation always works. And that's why it also includes revenues and expenses and income and things like that, because it includes everything. So to backtrack a little bit, what happens, for example, when you get cash from a customer, right? So you debit cash and you credit, say it was a sale, you credit revenue. So you credit sales. So the debit credit always balances each other out. It's always a balancing act. So the debit credit balances things out, and we're going to learn which one offset to which ones. But think about it as always like, okay, so I got money, that's debits increase assets. So what's the credit? Sales is a credit account. And it increases revenue, which ultimately will impact increasing equity, which is also a credit account. So we're going to get into kind of like looking into how do you balance out all these debits and credits. And it's not so much that I want you to learn and memorize this. I think it's, there's a little bit more intuitive ways to learn this. But the idea is that you want to learn the definitions also. So the journal is basically used to be like a ledger that's physically you record debits credits on like a piece of paper, and it has obviously evolved into an accounting system. So if you think in the context of what's going on right now with information technology, as I'm sure obviously you all know, a lot of this stuff is now so different. You don't sit there and you figure out debit credits. There's software that you put this into, and they pick it up. So it might be something that I would be able to actually put on the video, is an accounting software of how you classify these things. But you could always log on to Xero.com and look at Xero. It's the most advanced small business accounting system now, or QuickBooks Online, and see for yourself. If you're really interested, it could be very good to practice this if you want to learn this stuff. So basically a T account, which is how we learn this stuff, has a left side and a right side. And with these T accounts, what we look at is, say it's cash, and we keep track. It's like, what's the debit, what's the credit, whatever. You're doing sales, you're paying bills, you borrowed money, you paid some bills, you collected on invoices. So cash will keep getting hit with debits and credits. Debits and credits. And we'll do an example down the line, I feel like. But the main point right now is that there's an ending balance. An ending balance that occurs after several debits, after several credits. And the important piece in accounting is that a balance sheet would include that ending balance. So now we're kind of went a few layers below. You had your balance sheet, you saw all that's cash. Well, how did we get there? Okay, we started somewhere. We had a bunch of debit transactions, a bunch of credit transactions, which means pluses and then minuses. And we ended up at a place where there's a balance. And what's beautiful, I mean, if you go into another level in the professional accounting, you keep track of that in the accounting system. And of course, with cash, you can keep track of it in the bank statement. And that's what I mentioned a couple of times, is that is kind of 50% of the work sometimes, is to make sure your cash includes all your transactions to date and you're aware of them, and that way your cash is fully reconciled.